Hello and welcome everyone to this new webcast on the Secure Act being co-hosted by Carson Group and NAIFA. And so we really want to thank NAIFA and all of the members for being part of this. Really exciting and for all the great work NAIFA's done on and kind of just moving forward legislation and being a voice for the profession. And we'll hear more from that as we move throughout. Again, I'm going to be kind of your host and driver of most of this here today to give us an overview of the Secure Act, some of the provisions, and some of the planning out there that I think you as financial service professionals are going to be able to take advantage of to get your clients in a better place. And we'll hear a little bit about, what are some of the things that are still ongoing in the retirement space down in DC and some of the great things that NAIFA is kind of helping move forward. Again, I'm Jamie Hopkins, the Director of Retirement Research here at Carson Group, and actually just recently stepped in to head up our coaching company, Carson Coaching. I'm still teaching at Creighton University out here in Omaha, Nebraska. And then my co-speaker and presenter today will be Judi there at NAIFA. And Judi, I'd love for you to just kind of tell us a little bit about yourself, what you've been working on, what you focus on. And again, thank you for being on here today.
Great. Thank you, Jamie. And thank you for hosting this really important webinar for people to get a better understanding of what SECURE is and what the rules are and what the opportunities may be. I am the federal lobbyist for NAIFA. I live here in Washington, D.C. on the Hill. My primary issues are tax-related and retirement-related, so that turns out to be a pretty big portfolio of issues. I was also the co-lead with my colleague Gary Sanders on the Regulation BI, now final regulation, and I had the lead on SECURE. So I've been working on this for easily 6 years. I came to NAIFA as a business owner doing employee benefits and financial plans, and so it gives me a unique opportunity to both advocate for NAIFA members on these issues, but I have business practical experience that I can bring to that has been very enjoyable for all of us.
That's fantastic. Yeah. So I guess, from me and many other members of the profession, right, thank you for your work on Reg BI and on the SECURE. So those are both pretty important pieces of legislation, law, and rulemaking out here in the last 2 years. So that's you've been busy to say the least there. So so thank you everyone. As the first half of this is really, we're going to dive into, just trying to better understand some of the complexities, the details, the nuances of what I would say are the major changes impacting the advisory, the insurance, the financial services world. As we kind of move into the later parts, we'll do more of the planning. But I do want to kind of just lay out what we're generally looking at here. We will hear from Judi and just kind of how NAIFA really, was involved in the lobbying, the impact, how this got done. That's really important. I mean, just to kind of continue to recognize all the great work that NAIFA is doing and how important that is for this industry and profession. Talk a little bit about the multiple employer plans, really something that we're not going to be seeing on the market for another year, but really, really big change. We'll talk about some of the lifetime income option changes in there, big impact, especially that one is that retirement income related piece, right? How are we going to get more people to secure income sources? What's gathered really most of the attention out there in the media, in the articles even that I've written, is really around the RMD provisions, the stretch IRA provisions, kind of, a lot of people keep saying going away. I mean, really they're modified, but big changes there. And then we'll talk about some of the strategies, life insurance, Roth conversions, charitable giving here at the end, and wrap up with a couple, action items and things that we think are valuable to pass along to the group of listeners here. So one other thing I want to make is kind of a housekeeping item. First thing is questions. So feel free to type in questions. We'll gather them up. If we have time to respond, we'll respond, but we will 100% get back to everyone. That's been pretty normal on our Secure Act webinars so far. The one I just did about 2 weeks ago, I think we had something where about like 70 to 80 questions come in, and realistically, I can't get to all of those, and that would take the entire webinar. However, we've been building a FAQ sheet around that, so we're happy to send that out. If there are new questions, we'll add them to that, answer them, and get it out out to everyone who has a question. So feel free to type in the questions as you go, and we will respond back to everyone accordingly. So last thing here before we hear a little bit about just kind of the history of the bill, the process that it took in NAIFA's impact, I just want to lay out kind of where I have kind of categorized the major provisions of the bill. While technically there are 29 separate provisions, obviously within each one of those sections there are numerous rules. So the number of actual rules in here are a lot, but there's 29 different sections as part of the Secure Act. There was a tax extender bill attached to this legislation too. At the end of the year, right, the appropriations bill. And so there were some other changes that kind of tied to the financial planning process, but we're really focusing in here today on the Secure Act's impact. And I really broke those down into what I kind of view as three different categories. One being the impact on the retirement plans that are out there, right, the tax credits, simplified safe harbor, automatic enrollment provisions, the multiple employer plan provisions. That's kind of the qualified plan world. We saw some big changes in the lifetime income option rules, so portability, simplification of annuities, some exemptions out there, a new calculation that's going to occur, again, not in 2021, but coming pretty soon. And then the RMD changes, really those impacts on the kind of when to take RMDs, the IRA type provisions. And again, those are the ones that have been getting the most attention out there, especially probably from your individual clients, but all of these are going to have big impacts. So at this point, I'd love Judi here to kind of tell us a little bit about this path to the Secure Act. As the kind of the lead on this, right? Tell us a little bit about the story and kind of how did this all start and just NAIFA's impact. And we'd love to hear about that because without organizations like NAIFA and you, right, this probably doesn't get done.
So this was a very interesting process from the beginning. I'll start in the middle, which is about the last 3 years. This package of provisions, not exactly the 29 that are in the final bill, but most of them, and with possibly very modest changes, have been in the works in both the House and the Senate for several years. And the Senate Finance Committee 3 years ago voted unanimously in favor of the legislative proposal. And then it sort of floundered in the Senate as the House, with literally hundreds of co-sponsors, sponsors on many of the provisions and co-sponsors of the entire package, started working as well to try and get it through the House. And our first effort at that was at the end of the Republican control of the House, where we were all really hoping that this would attach to or right along with the Tax Cuts and Jobs Act. And in the very end, because there was some perceptions that this started at Senate Finance Committee, where it was known as RESA in the acronym, Retirement Enhanced Savings Act, the House decided not to include it on the TCJA. So we lost an opportunity there. We scrambled back. The new chairman of the House Ways and Means Committee, Chairman Richie Neal from Massachusetts, huge proponent of retirement. He made it a priority, and so now the House was involved again. And in this process, NAIFA executed every resource we have. We do have the most phenomenal grassroots, and thank you, listeners, all of you who did respond to requests to call your lawmakers, email your lawmakers, come to Capitol Hill for our annual congressional conference and speak with them in person to talk about what kinds of important future savings security this bill would offer to NAIFA kinds of middle America, mainstream families as they prepare for retirement. We used our own professional staff, literally hundreds and hundreds of meetings with lawmakers, with their staff, with our coalition partners. We had CEO level meetings. We've sent letters to the editors in local newspapers. We used the what I call the NAIFA strategy towards advocacy, which is leave no stone unturned. Even if strategies were contradictory to each other, we've always used all of them. And so if we move forward a little bit, I can give you what the last few yards look like. Secure is how it became known in the House. came out of committee with a markup very favorable, went to the House floor. Of the 425 House members who were there to vote, only 3 opposed the bill. It got sent to the Senate. And in the Senate, we were trying to pass it using a procedure called hotline. So rather than come through committee again and go to the floor, where Senator McConnell did not want bills coming to the floor, the hotline procedure requires 100% unanimous vote in favor. And we had 97 favorable votes and 3 that had holds on the package, not because they opposed the pieces in the bill, but they either were using it as leverage for something else that they wanted from the senator, or that they wanted some expansions of a couple of the things that weren't retirement related that are in the bill, including expansion of allowable expenses in a 529 educational account. So we again did the whole sort of frantic call members of Congress, work together with the committee staff, work with leadership to see if a spending bill that would be must pass, Washington D.C. term, a must pass piece of legislation, and that would be the appropriations bill that did in fact come together in December. And so that package did allow SECURE to ride along. It passed in the House on December 17th. It passed in the Senate on the 19th, and the president signed it into law on December 20th. So it is enacted. Because all of that happened very late, and Jamie might talk about some of this in the future, some of these effective dates are pretty tricky for some of the plan providers and so forth. There is revenue in this bill, and I'm going to tee up for Jamie's later conversation. Even before the Senate Finance Committee voted this bill out in 2016, there was clear understanding that there needed to be revenue offsets, that this needed to be a revenue neutral package. And the Stretch IRA is been out there in what I call the Sears Roebuck of revenue book for a long time with a big fat number on it. And so when you see this revenue impact, it is revenue neutral because of the changes that they made to inherited IRAs, which Jamie's going to talk about at length. And so, Jamie, what now? The law is enacted.
Yeah, so the law is here, and as you said, that really to some degree, if you look at the bill and the revenue of it, there's 29 provisions. There's a lot of tax benefits in the bill, and to get there, something had to pay for it, and essentially that's the modification of the stretch. So, to get there, you needed something as a revenue item. Now, I just kind of wanted to list out a couple things that I kind of view as what's coming next, and I know Judi has some thoughts on this too, and we'll hear some of these throughout. But when people ask me what's the stickiness of the SECURE Act, is it here to stay? And I think you heard this. There was actually a lot of bipartisan support here. Very little, kind of in either the House or the Senate that were pushing back against it, and even the ones that did, it was for some more minor provisions, especially in the Senate version. But here, right, I expect this is as permanent, quote unquote, as any law is. I think we're kind of there. A lot of these are common sense changes, good changes, aligning with the public policy that we actually had before the bill was passed. So the other thing I like to throw out there, though, is to me, we have some other big things on the horizon. One of them is that, while the bill did a lot of, as I say, common sense positive changes, on the flip side, our biggest kind of issues around Social Security, Medicare, Medicaid are kind of left out there still today, right? We have some proposals out there in front of Congress. There's just not a ton of movement right now on those. And again, I throw this out there when I do presentations, at least with Social Security, the 2033, 2034 date is a big date from the sense that's truly when the system breaks. I don't have a lot of good examples here of when the government fixes something like that 14 years before it breaks. And maybe Judi has a better one. But, we tend to see that stuff get fixed a little bit closer in time. I think everyone would like to see something done there, but it hasn't gotten the kind of full support and movement yet. And then, again, I'm kind of expecting to see another tax bill at least by the end of 2025, because a lot of the Tax Cut and Job Act provisions, right, would go away by then. And we kind of get in a bad spot if we let that bill just kind of disappear. So whether it gets extended at some point, redone, whatever it is, I do expect some other tax bill. And I think, Judi, when you and I were talking before, you think there's going to be some more retirement legislation in the works over the next couple of years too. Is that still your kind of where you're thinking?
I do, and I base that based on proposals. I base that based on on proposals both in the House and Senate by retirement champions like Ben Cardin and Rob Portman in the Senate and Chairman Neal in the House. I think that proposals are out there, will come together with the little version of a retirement 2.0. And I suspect going forward, we will see more bills that will follow the model that was secure, with separate minor provisions that come together in a kind of cohesive package where you can drive large bipartisan support and get it completed and to the benefit of American people. So I do think we'll see a retirement one. To your point, there are a lot of proposals and nothing really moving right now. This is in probably next year as well. Probably not good years. So I agree with you completely.
Yeah. So now let's actually start kind of getting into some of the provisions, as I know we're a little bit in here, and I tend to move fast for those people who have seen me present before. So the good news is there will be a replay. So in case we fly through things and you're like, I wanted more, you can always rewatch it, and we will be doing more of these events over the course of the year too. So the first one here is multiple employer plans. This is a big provision. There's been a lot of support around it, and essentially it's the idea that we're going to have, right, a cheaper, lower cost, easier setups for small employers, right, that we know are not getting their individual employees into retirement plans here today, right? Like, that's a big deal. And so, Judi, I know I was actually going to stop on the last slide, but this was a big provision, right, that is important as part of this legislation. So you just kind of want to tell us, as that general overview of this, where was kind of NAIFA in this process?
So this particular provision is one that, to your point, not effective until 2021. I think is going to be the most interesting to watch in the marketplace because of all of the provisions. It is the one that will make it so much easier for small to medium-sized employers to offer plans to their employees, and as importantly, for the business owners of those small entities to be able to save at maximum amounts that they can't do in some of the other plans that are available to them, and with as much ease as one could conceive by being able to adopt into an existing plan that has, I'm going to loosely call them professional fiduciaries, but fiduciaries in place so that the business owner can focus on growing his business. And there's very little of the administrative and fiduciary duties that occur even with current versions of multiple employer plans. So this one in particular, I'm curious to see how the marketplace will respond, and is the other area where, as we talk a little later, may need some help and guidance from agencies or clarifications from Congress.
Yeah, absolutely. This is the one I say it's a long-term play, right? It's not going to, change the world in 2021, but do we start getting adoption? Do we start getting more people saving? And so this is kind of an important thing to kind of lay out. A lot of people hear the multiple employer plan language, and you say, well, we already had those, right? And mostly what we had is these closed multiple employer plans. There were some association style ones too that were a little bit different. But generally that we had to have what we called this common nexus or interest. That means we only had people wrapping into these multiple employer plans if they were all in construction or they're the same organization and, but different tax filings. And so it wasn't this really true open source of multiple employer plans. And that's one of the big changes here is that we're not going to have any business connection. We're going to have construction companies and attorney groups that can roll up into the same one. That's really interesting, right? That changes the rules dramatically. Some of the fiduciary pieces, as Judi mentioned, they made that a lot easier here. Basically, the one bad apple rule is that we often hear it referred to as if somebody else messes up their funding, that's not going to cause the plan to run into problems. and all the other member organizations that are rolling into it and using it to run into problems. So again, this is really 2021 timeframe, so it's still a little bit down the road. And again, it's still going to take time to set those plans up and get people to adopt them, but we're really going to see this roll out in 2021. I've talked to a lot of the large plan providers out there, and they're going to do something in the area. Everyone's still trying to figure out exactly what they're going to do, but they are going to be involved in this area. And right, you see some of the things around it, right? It's pulling these plan providers together, single plan document, single filing, single independent audit, reduces the cost of the 401k, right? Removes some of the liability issues and concerns and penalties here about the one bad employer who doesn't follow all the rules, right? Now, I do put in here one of the downside or kind of challenge piece here. The downside is, right, this will be more of a standardized plan. So those who still want to create their own more robust or different type of plan, if you're trying to maximize after-tax contributions to do the mega backdoor Roth or something like that, you're not going to. This is not going to be your solve. But it wasn't what it was designed to solve for. And then I think on this side, and I'll let Judi hop in here on this piece too, because I know NAIFA is kind of making some, kind of taking a stance and helping on this piece. Is we've seen this at the state level, these automatic IRA plans been popping up, and there's been legislation, there's been some rulemaking, and so to my view, when I first saw this, I said that's going to put a lot of pressure on these state IRA plans. If we see adoption of these multiple employer plans, does that really solve the problem to some degree that these automatic state IRA plans were trying to solve? And so, Judi, did you want to hop in on that piece at all? Because I know that's something NAIFA is working on.
Yeah, this is something we're working on, and we do think that it gives us a good argument to go to the states and say, the marketplace is going to take care of this. You won't need to do an auto-enroll, IRA kind of plan. And for a lot of reasons, they should let the private sector step forward. One, the state plans have ERISA preemption, so those participants don't have the benefit of ERISA protections. As they start up, they're more costly than other plans, and the costs, of course, pass through to the employee participants. And they will have far less in the way of choices in terms of investment options and in a lineup, and possibly less in the way of employer matching and the kinds of features that you can get in something that would be a little more robust. So it is our hope that as these plans start to come together and be made available, that there is a demonstration in the marketplace that employers who otherwise were not providing plans see that they can, and that it's something that they can do without being without suffering the impediments that occurred before, and that will really negate any need that the states think that they have to do their small Roth only savings arrangements. And the states could use their funds better, we think, for financial literacy and education. So we are going to use this as an element to say, we're ahead of you, actually. We're ahead of you, the state plans, and we do it better.
Yeah, I think that's great. Yeah, and that's kind of what one of the concerns about these were originally, the state ones, is, right, are better 401k plans and employer plans going to get dropped for these really kind of low solution Roth IRAs? Exactly. And I think that's an important thing. I'm not going to spend a lot of time on this here, but I just kind of drew this up as a visual, right, to understand it, right, is what you're going to see is this larger 401k with unrelated employers basically to roll up into that and use it. And then you'll essentially be running, as Judi said, right, the fiduciary out of there. You're going to be running the reporting out of there. And it's really just going to allow for scale that we otherwise don't see in other places. A couple other things here, just quick ones. I'm not going to dive too deep into these. There were 2 new tax benefits created about starting a retirement plan for a small business, and then one about adding automatic enrollment. That's actually to an existing plan, or if you start a new plan with automatic enrollment, a new tax credit for small business owners. And we saw a move up in the cap for automatic enrollment safe harbor plans. So actually that ability to automatically enroll and escalate people up to a higher amount than we saw before. still has the opt-out provision there, so people can choose not to do that, but allows us to kind of set up plans that get more and more people saving. So as you can see, this whole first section of the Secure Act really was about driving small employers to get plans, more people get saving. This one here will be kind of another tie to that, part-time workers. I used to always call this the 21-1-in-1 rule, and I guess I would have to modify that now if I was still teaching this. But this was age 21, 1 year, 1,000 hours. It was nice and easy. That's when you became eligible to be counted or required to be counted under the plan. And what they're going to do here is really say, hey, look, if you have long-term, part-time employees, 500 hours of service in at least the last 3 consecutive years, and still reach that age 21, you need to be counted under the plan. I think the big question here is, do we start modifying plans that just say, hey, we're not going to check the past 3 years. We're just going to roll with 500 hours instead of 1,000. To me, I think there's a lot of benefits from that, from an administrative piece, but again, designed to kind of move this forward. However, looking at the actual impact of this one, it's going to be years out. 2021 is actually when this one goes into effect for the most part, and it actually starts looking at the 3-year from my read of the bill there at that point. So it looks like 2021, 2, 3, that would give you your 5 years or 3 years of 500 hours. And so it wouldn't be till kind of 2024 that you'd really have to drive a change. But if plans modify their provisions and go to the 500 hours earlier, we could see this have some impact a little bit earlier. All right, so switching over a different piece here, kind of moving from the small employer world, a lot of positive changes there, over to the lifetime income changes. And there's actually probably 3 big ones here. And so, Judi, again, hop in here. Tell us a little bit just about why this was so important. And I think this even ties to some of the things that have been going on out there, even like the Rolling Stones piece. I know that wasn't from NAIFA, but, getting the alliance there to support lifetime income. And we keep hearing, the industry kind of getting behind this. And some of these provisions, I think, make a lot of sense and have been out there for a while, too.
Yeah, so I think that, the ideas behind using securities to provide lifetime income, clearly not a new idea, but how to do that and when to start funding for that, I think the opportunities are enhanced here in 2 regards, really. One, making it, again, using the word easier for employers to offer annuities in their investment lineups, in their plan lineups. And 2, making it easier for employees to select that as part of their allocation of contributions to the plan without having to worry that if they leave that job or employer, that they would suffer the potential surrender charges of the annuity because it can't be transferred in kind. And so these provisions really address those 2 concerns in a way that I think will allow employees to choose an annuity in their plan lineup and start funding an annuity to have some sort of lifetime income guarantee in their portfolio much sooner than when they're just retiring and rolling the assets out into an IRA. So I think that that it goes a long way. And again, it's a smaller provisions, but I think will have a significant impact on long-term financial savings.
Yeah, excellent for that. So, yeah, one of the things here, is kind of, you said in-plan annuities and 401ks. It's a pretty small percentage of plans today. I, found at least one survey that was saying I think I've seen 2 now that say it's in that 7 to 8% of 401k plans have an in-plan investment option annuity. So that's a fairly small percentage of plans. So part of this was to kind of get more plans to have annuities inside of there, and it kind of have that bottom point, and I think this is where there's obviously discussion around this, is kind of what's the right way to use an annuity, is both maybe an accumulation investment vehicle versus a distribution option. We're much more common, for retirement plans to have some type of annuity form of distribution. Obviously, pension plans and defined benefit plans, that was the core of the plan. The next part here is, so how did they kind of move forward to kind of fix this? And that really is essentially providing some relief to the employer, right, the sponsor of that 401k, from some fiduciary liability, and giving them a process and kind of almost a checklist of things to vet with an insurance company, the provider of the annuity, before adding the product into the suite of investment options. So basically going back 7 years, making sure they're licensed by the right state, that they're working with the insurance commissioner there, that they can provide the contracts and meet the requirements that they say they are going to in there. They've met all their financial audit statement requirements, that they maintain proper reserves in all states it does business in, and if any of those things change, that they agree to notify the sponsoring 401k and employer about the changes. And so, again, what they say here is you need to review the financial capability of the insurer at the time that you make the selection. That's what's important. They also made a note in here as part of the rule that, right, it's not a requirement to just go find the cheapest provider. You still have to be worried about reasonable costs, but this is a little bit of a change, right? Just trying to make it easier to get these investment options into the plan. As I said, I don't expect to see a tremendous change in 2020, just because it does require plans to add, right, the annuities into the plan still. So there still has to be a change there on the investment side. But I would expect by the time we get to 2021 to actually see more and more plans having these, annuity insurance options inside of the plan. Judi mentioned this one. If you're thinking, hey, we're going to get more annuities inside of plans, well, this is also allowing us to get them outside of the plan. And the portability of annuities, and that's a challenge before the SECURE Act, is you could all of a sudden, right, not have the ability to roll this out in kind, and you have people inside of plans suffering from, right, kind of penalty fees, et cetera, surrender charges, by when the plan drops the annuity or they try to roll out. So we had basically a new portability provision here, that if the annuity is no longer an available investment option inside the plan, you've got 90 days where you can get an in-kind distribution and get that out to another 401k or IRA. So that's really helpful. I mean, that's really keeping people from having to, kind of cash out of one of these, right? Quote unquote, cash out too early. So that's a great change. Really is kind of very consumer focused on that side. Next one here, and this has been discussed for, I think, about as long as I have been doing retirement income planning. So I think
maybe as long as me.
Yeah, I was like, when are we going to have that disclosure, right? When are we going to stop focusing on that, right, magic savings number? And that one, right, that one's, while it's in the bill, I even say it's not all the way done yet, because really what they did was kick it over to the agency to figure out how to do this. There's researchers out there. I remember talking to Mark Warshawski about this probably close to 10 years ago, and he had his vision of his model was the best way to do the calculation. I think that's a big piece of this. What do we come up with? I think the short answer is a lot of 401ks and 403bs have something online that shows this, and man, oh man, are some of them bad. Like, I have seen some that make no sense whatsoever. I try to figure out how they're generating the income in the future, and I have no idea. So we'll get some consistency here. It'll help people start focusing on income over just a savings number, right? Like, we've got to move there, because that's really what it's all about, is in retirement, the income we can generate, not that we saved X amount of dollars. And so Judi, you said this has been going on for about as long as you can remember now too. Is there any kind of hurdle that you're still seeing for these? I mean, we're still a couple years out from when we're supposed to kind of see it in plans, but I guess you'll probably see some involvement even with NAIFA here as the DOL or whoever proposes a rule.
Right, and so I think you identified the hurdle. Is DOL is now tasked with writing a version of a safe harbor, because to your point, those online tools that people use where you can choose any number of combinations and assumptions, and the result is, of course, garbage and not something that you could rely upon. We will have some consistency here. I think even if they write more than one safe harbor, then a plan can choose which one they're going to use to be able to your point, so important to be able to say, I have this pile of money. It seems like I'm doing a really good job, but nobody's equated that for me into how much I can spend every month. And that's a number I actually know and understand. So I think it's a really important piece. And I think that, the agency will have some work to do. NAIFA will be in with the agency on some other things, and we'll offer our services any way that we can to get one or two calculations that are reliable and consistent, and then help people do what they need to do to meet their objectives.
Yep. Yeah, I think that's really helpful. One thing I just want to bring up, and I have, maybe huge is the wrong word, but I've been on a call with a couple people, Curtis Cloak, Gary Medler, a couple of the other kind of thought leaders out there in the insurance and annuity world, and I know NAIFA is aware of this now too because we've discussed it, and so we'll be looking at this. There was we didn't get to this piece yet as the technical part, but the 10-year stretch provision. There are some concerns out there with, how are some existing annuity policies that are inside of, the IRAs and also policies that are being sold right now. Are they going to be compliant with that 10-year distribution period once the owner of the account in the IRA dies and they get passed over to somebody else? There was a grandfathering provision for essentially those SPIAs and other annuities that were in payout that have been irrevocably designed for their payout for life before the end of 2019. But the reality is those policies are actually still being sold today. And so we know that they existed before the end of the year and they built a provision to grandfather those in. But what happens in 2020 and beyond if we've got policies that are not going to be compliant with the 10-year distribution period? And so I think it's something, if you're looking at this, just have it in your mind, and start thinking about if I'm selling a policy inside of a qualified account to a potential, that our next beneficiary of the annuity, will the annuity be compliant with that 10-year? Could there be a modification of the contract? But that's an important thing. Now, there's a bunch of exceptions that could apply here, but it is something that right now I just think education-wise we need to be wary of, and as we communicate with clients, just that we're communicating the information over appropriately. I mean, the insurance companies will do what's right, and they're going to get the right language in the disclosures. They're going to get a fix out there, but it is just something I would say to kind of keep your eye out there on. So this one here, I guess kind of the RMD and stretch, and even talking about the last piece there, Judi, you're probably going to be looking at a technical corrections and maybe some, I think you mentioned before, from different agencies, some rulemaking. So with the annuity piece, some of the other pieces of the bill, do you think that there's some avenue there that that NAIFA and others will be working to kind of look at some of these smaller issues that might still be popping up in the bill as we go?
So I do. I think that NAIFA, because we do have strong relationships at Treasury, for instance, an agency that probably will have jurisdiction over a big piece of this, and the Department of Labor, again, lots of jurisdiction here. I know for one, even I could throw at once, if agents bring employers to a multiple employer plan, we would need the Department of Labor to write some sort of prohibited transaction exemption to allow the financial professional to be compensated. So there are things that that either Congress, in the way of technical corrections, or these agencies can do to offer the guidance so that there aren't, inadvertent administrative mistakes in taking advantage of the changes that we're going to see roll out here in the next little bit. So NAIFA will be using our relationships to make sure that whatever we get in the way of guidance is both clear and workable.
Great. And I know this is one of the we kind of hit this earlier here. The 10-year stretch, is you said it was kind of a necessary piece. It's been on the revenue line for a long time.
It has been around. It clearly isn't something that NAIFA has supported. We've had so many conversations over the years. We actually do like this version over prior versions that we've seen because of the few things that you're going to talk about, that it's not that the RMD is by the 10th year and not over 10 years, and 10 years is better than 5 years, arguably. But not something anyone was looking for, but again, something that in the big picture, we all kind of decided, NAIFA and the other insurance companies and the other trades said, well, we don't like it, but we like all these other things, and if we have to find a pay for, we'd rather it be one that's structured the way we like it, and here in a bill where we're getting the things we want from it, than have it be randomly picked up on another piece of legislation that needed revenue that was absolutely unrelated to retirement savings. And to your point, Congress is not going to be terribly sympathetic about making much in the way of changes here. They don't view the Stretch IRA as intended to be a wealth transfer tool. So the clarifications we'll be getting, I think, will be more on the administrative and the compliance side than any real significant changes to the rule itself.
Yeah, and so for a lot of people, that one piece you mentioned about by the end of the 10th year, that's actually really important. It allows for a lot of flexibility and planning, right? That you do have to distribute this IRA defined contribution by the 10th year following the year of death. That actually went into effect for most plans January 1, 2020. Government plans, though, still 2 years out. So there's actually some plan that says, hey, leave them alone for right now. Don't roll them over to an IRA if you have somebody that's already sick. The other thing, kind of that, right, we had 5-year distributions on the table, right? So that's been out there for a while. And what we'll see here is we got a lot of exceptions here to the 10-year. So, again, that's still some stretch. And as Judi kind of said, that Congress isn't real sympathetic towards this, because what we're mostly looking at here for people who are truly stretching today, they're larger IRAs. It's a wealth transfer and tax benefit. And the Supreme Court has already ruled that inherited IRAs and 401ks, right, are not retirement accounts. So if you take the grand law, right, of the land from the Supreme Court itself, and you apply that, it gets very hard to argue why, from a public policy standpoint, somebody should get tax benefits all the way through retirement on something that is not being treated as a retirement account for that individual. So to me, I've been expecting this to occur, and honestly, I thought as the revenue that comes from it's substantial, from the current rules, that I was actually kind of surprised somebody hasn't attached it, as you said, to a completely unrelated bill at some other point just for the revenue of it. So again, big exceptions here. If you died before, right, the start of 2020, so up through December 31, 2019, you're grandfathered into the old rules. For government plans, that's going to run out to December 31, 2021. Now, here, the 10-year does not apply to, right, at the date of death, surviving spouse, disabled, chronically ill. People usually ask, what does chronically ill mean? That's typically, essentially the same code section that describes activities of daily living for long-term care. So you almost think that's long-term care eligible. Or an individual that is not more than 10 years younger than the employee. So the individual passes away, leaves it to somebody that's 5 years younger. We will go to the essentially using that person's life instead in most cases. The other part here, child of the employee or IRA owner, remember that has not reached the age of majority. It actually says child. It's not just minor. That's a big piece because it means grandchildren, right? 10-year-old grandchild, basically 10 years, right? So we're actually going that route. Child up to the age of majority. Once they hit the age of majority, you can get a 10-year. I did think I saw something by Natalie show basically talking about there are some other strategies you might be able to push that out a little bit further. I think maybe all the way up to 26 and then 10 years, depending on some education provisions. But that's going to be fairly minor and kind of broad planning capabilities. But there will be some new wrinkles that we see in planning, especially around the minors as this bill progresses, and we kind of just get more time to digest it. So what does the stretch mean? The first one we've hit multiple times, increased taxes. Why is it increased taxes? We're having a reduced time period in which you get the tax deferral benefits. Think about who inherits these, right? I was actually on NBC earlier today, and this was one of the questions they asked is, why is this such a big tax increase? But think about 85-year-old passes away, right? Pretty close to average life expectancy. Passing away, how old's their kid? Their kid's 55. And their kid's 55, and where are you at 55? Hopefully, you're probably in the highest earning years of your career. So we're taking large distributions out, right, on top of, right, your highest earning years ever. that's going to cause a tax increase in a lot of situations. So that requires us then to do better planning about our beneficiaries, better total wealth tax planning across both the lives of both spouses and the designated heirs. Now, the bottom part here is it also opened up some charitable planning possibilities. I think I've got a slide in here on this later on, demonstrating charitable remainder, annuity trusts, and CRUTs, and the benefits of actually leaving a portion of your IRA over to them, and actually leaving the lifetime income over to a surviving beneficiary, and your total wealth transfer can actually be increased by those strategies. So next one, we kind of hit that already. I mentioned this one, grandchildren not exempt under the rules. So minor grandchildren, 10-year rule is what's applying. Not a great outcome. So let me walk through an example of kind of the rule change here. I found this to be pretty impactful when I went through it the first time. So I actually have a 45-year-old and 85-year-old here. The life might be a little bit different. We could change those. You can make the person who died younger. It doesn't really matter on that side. But 45-year-old inherits $1 million IRA, right? Under the old rules, right, we get 38.8 years, right, as our life factor, basically 39 years to divide this thing out. And that would give us about, right, $25,000 under the old stretch. Now, while the IRA would not have to come out under the 10-year rule till year 10, I just levelized it here, and I'm just saying, hey, let's just take $100,000. I'm also not factoring in growth here on that account. So all those things, right, it's a kind of a simplistic look, but I don't factor in growth on either side, so it's kind of the same piece. So the next part here,
sorry, Jamie. I do think this is a really good illustration of the impact.
Yeah. So the next part, yeah, it's got a huge, just that alone, right?
Yeah.
You're like, look at that taxable income increase. So think about this just on this slide. So I dropped in just the tax rates for 2020. So let's just think about somebody, right, who is in any of these tax rates and adds $25,000 of income onto their range. Well, if you're at 80,000 and you add 25,000 on, you stay in the 22. Or if you were a single filer and you add it on, well, you stay in the 22. Now think of it, look at these, and tell me how many of them, if you added $100,000 taxable distribution on, would you not move up at least one, if not more, right, marginal tax rates? Right, if you were an individual, right, and you added on 100,000, right, almost across the board you would move up at least two, right, regardless of where you are. And that's a big difference. The only time period where you would not force somebody to move up to a higher marginal tax bracket is if they were at the 35% tax bracket, right? That's it. And that would be to the 37, which there I'd say, hey, the impact isn't all that bad. It's 2%, but some of the other ones, right, we might be jumping 8% on the taxation of some of these distributions. That's a big deal. So then I have two scenarios here, Keep It Kathy, and we're going to have Pay It Penny. Keep It Kathy is operating under the old rules, right? And I kind of grabbed some numbers and, just ran these through a simple tax calculator for Pennsylvania. And so $1 million inherited under the old rules. She had income of 130, 24% marginal tax bracket, added the 25,000 on, went up to 155, stayed in the 24%. Her effective rate was at 18%, and she paid roughly $43,000 in total taxes. I do have FICA and other things built into that, a 3% Pennsylvania state income tax on her kind of income here, not on the IRA, but on the other side. Then we go over to Payout Penny, and Payout Penny is now under the 10-year SECURE Act rules. Same baseline income, 130, adds now $100,000 on, again, just levelizing it here. Her marginal rate goes from 24 to 35 at the highest end. Her effective rate goes from 18 to 22, right? And her total taxes paid go to $70,000 up from $43,000. $27,000 more in taxes due to this change, right, in a single year. That's tremendous, right? And you can just see the effective rate is actually a good example of the true impact of something, right? So basically, right, the effective rate on all of her income, right, not just on that distribution, but all of her income moved up almost 4.5%. That's less money she's getting, right? I mean, that's where, when we're thinking about where is that government revenue going, we just demonstrated where the government's driving revenue from this. Now, as I say, the bonus tax issue, we're not done yet. We actually can see a lot of other areas where taxes increase. So net investment income tax. Now, while distributions from an inherited IRA or 401k are not net investment income, they can move your threshold, right, your income up, which can then subject your net investment income, right, to the additional tax. So that additional tax of 3.8%, if we go back to the same pay it out penny one, and let's just say 30,000 of that initial 130 was actually net investment income. At 130, she doesn't cross over any of the thresholds as an individual. It's 200. Even with the extra $25,000 under the old IRA rules, doesn't cross over the 200. But with 100,000, she goes 130 over. And then that actually subjects that entire 30,000 of net investment income to the additional 3.8% tax. Driving all the way down to the bottom there, I actually had all this written out, but I did it by memory. That's pretty good. When you get down there at the bottom, over the 10 years, that additional 3.8%, if I'm assuming here that she has that net investment income coming in, right, for the 10-year period, it causes $11,400 of additional real dollars in taxes, right, that she is losing due to moving from a essentially 40-year payout period to a 10-year payout period. Again, more taxes being tacked on top. And it's not because she has more net investment income. It's because she's moving her threshold, that modified adjusted gross income, up over the ranges, and that wouldn't have happened in prior years. So that's just another thing to watch out for. So again, end of stretch means a lot of things: higher taxes for people, less tax-deferred growth, and possibly higher taxable income and modified adjusted gross income that can cause the loss of other benefits, tax credits, deductions, and actually creep in other taxes onto your income. So it's meaning a lot of things here. I know we kind of, I think we jumped ahead on this before, so I'll probably ask a slightly different question. This one got a lot of attention in the media, right? This, hey, 70.5 is moving to 72. It's not a bad thing, Judi, but I would say this is probably not going to solve the retirement planning crisis or shortfalls out there, is it?
Yeah, I don't see it solving much of anything except possibly easier to calculate 72 than 70.5 for people doing math. Yeah, it's minor.
Yeah, it was one of the things that people always wonder why in the world is that 70.5, and figuring out when you reach 70.5 was always a good test question for the CFP exam and things like that. But that might be about the extent. Those questions are a little easier now to calculate. So, but I mean, it's a little bit of relief. But remember, it's for a lot of people, the first year they reached 70.5 was also the year they reached 71. So this is only a pushback for 1 year for half the population. For the other half of the population, it'll push it back 2 years to start. So that's a little bit of relief. But we know a lot of people at age 70 and 70.5 are already taking out, I think it's about a quarter to a third of Americans pull out more than their RMDs every year at that point already. So those individuals need the income. They're still going to be taking it. But it will give some relief here. Now, the rules here, little bit complicated, but fairly simple if you kind of pay attention to the details. If you reached age 70.5 by the end of 2019, that generally sets your required beginning date, which means you needed to have started. It's those who were not age 70.5 by the end of 2019. They'll now be age 72. The other important part about this to pay attention to is the IRS does have proposed lifetime factor tables out there that essentially would extend out the lifetime factor tables, meaning that your divisor is going to be a higher number, meaning that you're going to take smaller amounts out. That'll actually have a bigger impact from a pure RMD perspective than the 70.5 to 72 change has. That's not been finalized yet. They had the proposed rules. I believe those are kind of still expected in the next couple months, maybe even right around now to get kind of done, and then likely we'll see them in 2021. Judi, is that kind of still what you're hearing around these, that those are just about done?
That's exactly what I'm hearing, Jamie. You're exactly right.
Okay, good. Yeah, so that'll again, the tough thing on that is a lot of people like these charts, and we have these lifetime factor charts printed out, and age 70.5 being the date, and it's a big change for a lot of marketing departments, I guess, too, to fix all of this.
Right, exactly. Well, and even if we say we think, that the agency's probably online and on track, they do just get a lot of more work to do too. So it could slow by a little bit, but I still think likely 2021, and we'll see something shortly.
Yep. Well, that's exciting. Another piece here, great rule change. You can contribute to an IRA after age 70.5. I hated this old rule tremendously from the bottom of my heart. It made absolutely no sense ever to me. You could put money into a 401k, a Roth, every other type of account except for an IRA. And basically, that's gone now. So for those, and this is good recognition of where the market is today, right? We have lots of people in the gig economy saving, working, right, after 70.5, driving Uber, all of those things. This opens up an additional ability to save, deduct, and continue to get a tax benefit and save for retirement. It doesn't exclude you from the RMD rules at 72, but you can keep generating that tax deduction and putting money aside. QCDs, qualified charitable distributions, age didn't change. However, there is an offset provision now if you make deductible IRA contributions. After age 70.5, you will add up all the total deductible IRA contributions, and they will actually offset, right, any QCD moving forward, at least the direct ability to have it not included as taxable income when you send it from your IRA to the qualified charity. It will still offset an RMD after 72, but that's just something we've got to be careful on. I've got an article on Forbes on that. Michael Kitces and Jeff Levine have an article up on their site on that. So I'd say if that area is a little bit complex, take a look at it. But again, mixing together qualified charitable distributions and contributions to an IRA that are deductible after 70.5 will offset each other. So we do just have to pay attention there when we're doing planning. So that's a big piece. The language fairly complex, but I tried to explain it down as best as possible. I'll give one quick example of this. I know I'm kind of pushing our time here today, but this is a kind of a good example. So let's just say 2023, 2024, you have a client after age 7.5. They put $7,000 each year into a deductible IRA, $14,000 total. 2025, they say, hey, let's do a QCD, qualified charitable distribution, from my IRA over to my 501c3 charity, $10,000. That $10,000 QCD, right, will essentially be offset by the $14,000 deductible IRA contributions. So we won't get the tax-free distribution. It'll be treated as a taxable distribution. It'll still go to the charity, and it'll still be a distribution, so it will offset RMDs. However, we won't get that charitable, right, deduction unless we're itemizing. So if we're still itemizing, outcome is pretty much the same. But if we weren't itemizing, no charitable deduction, the $10,000 QCD is taxable distribution and then treated as a gift that we couldn't itemize and deduct. So again, watch out for that. It's kind of a tough piece to kind of plan around. So right here, we'll try to just cover a little bit here on kind of the mimicking strategies. As again, I said, I'm cognizant of time here. But Judi, I know this, as you said, isn't what you spend all of your time on. You're really on the because the government side and our lobbying efforts at NAIFA. But NAIFA does a lot on the education and planning side too. So I think it's probably good to mention a little bit about that here. Well, hopefully Judi is still there. But I'll kind of just...
Sorry,
yep,
I was on
there
mute.
you are.
Yeah, so there's really now an obligation, right, to go review any existing planning strategies with this. And that need to review obviously opens up opportunities. You're going to talk about some of them. NAIFA's Professional Development and Education Department is now taking the baton sort of from advocacy to their department so that they can be working on educational materials, strategies, ideas to be able to take and use with clients and prospects under this new law. And that department will be doing their NAIFA Live and their workshops and other programming so that NAIFA members and financial planners can understand both the rule and the impact and the opportunities that are there for their clients, which you're going to go into some detail on now. So I know we're out of time, but you know that old saying, there must be a pony in here somewhere. Maybe if we don't like the stretch IRA, there is a pony in here somewhere, and we'll find some good ideas.
Yeah. So again, due to time, I'm going to try to hit a couple of these. We might run a couple of minutes over the hour because I think it's important to hit a couple of these. But planning strategies to consider, right? When should we roll over our IRAs to our spouse? And actually, sometimes we might decide not to, and actually leave them to the kids earlier to allow the kids to get the 10-year stretch. And then perhaps maybe when mom passes away later, leaves her IRAs and retirement accounts over to the kids, they can start a new 10-year distribution period with those accounts. Annuity contracts are a great way, again, here to think about tax advantage ways to stretch income over a beneficiary's life, so non-qualified or some of the qualified situations. Roth conversion is going to get the gold star here. I think we're going to see a tremendous amount of Roth conversions. We saw a lot of Roth conversions after Tax Cutting Job Act, lower tax rates right now. And then now, wouldn't I love to have 10 years as a Roth IRA, where I could leave it for all 10 years as a wealth transfer vehicle, let it grow, and then take the money out? Whereas my tax-deferred IRA, I kind of dread taking the distributions. I dread letting it sit for 10 years because then I'm going to have a giant distribution on the 10th year, where the Roth is actually, looking pretty powerful there as a kind of estate planning tool here. The other one I think is going to get an absolute huge boost. Actually, I should say two, sending IRAs to charitable remainder trusts. That's going to get a big impact. And then life insurance max strategies, where we're maybe even taking the RMD out each year from our IRA and then buying life insurance to generate that tax-free income to the beneficiary. So a lot of strategies out there on that. I'm going to hop over here I want to show a little bit of the charitable remainder trust piece, and then one example actually from Robert Keebler here that he kind of demonstrated in his presentations. We have that in here too, just to highlight it. So this is going to be a great strategy. This is, ask your clients, are they charitably inclined? And do they want to generate income for the life or a large term over 10 years to their children or other beneficiary? So you name the charitable remainder trust as the designated beneficiary of the IRA. So that money doesn't get taxed right away when it gets inherited there. And it can actually, the charitable remainder trust can send out lifetime payments to your child. And then the remainder goes to the charity, and you get a deduction for that remainder interest up front for the IRA going into the charity. So it's a great estate planning tool to get that stretch provision, essentially lifetime income to the children, and donate to a charity. So then, as I said, Bob Keebler created this one. I've got the citation there at the bottom. Basically, some of his assumptions around $1 million IRA, some growth, and then looking at a 35-year stretch provision. So this is, right, if you just left the IRA under a 10-year rule, which is kind of the bluish in the middle next to the green, the amount of money total that would net out to this individual. And then if you look, right, if you look at the IRA CRAT, Charitable Remainder Annuity Trust, it's less, but it's comparable. It's actually better than a full liquidation of the IRA or a 5-year liquidation of an IRA, which we heard before could have occurred. And actually, in this scenario that he ran, the IRA that's using a charitable remainder unit trust with good returns during that time period actually outperformed a 10-year, just a direct beneficiary gift of this because of the tax play that occurred there. So you can actually give more money in some cases in this. I actually say that's usually not a great public policy piece. Typically, when we're giving to charity, we want to have, right, that actual charitable bequest, but you can actually demonstrate by using this right now, you can actually transfer more wealth using a charitable remainder trust than just directly giving the money to your children. I'd say that's kind of a challenge on the public policy aspect, but it's a great planning outcome. And if your job is to take care of your clients, this helps. Now, if you add both the charitable gift and the family gift to both the CRAT and the CRUT versions of remainder trust outperformed in this scenario just the 10-year stretch IRA. So again, this is going to be very powerful. And what I say is just run the numbers. At where I work at Carson Group, we have a trust department. And when people think about this, we just run the numbers and we see how would this perform in their situation. If they want to give to charity, it's a very valuable piece. So, all right, concluding thoughts again, right? Make sure you're reviewing the beneficiaries because the stretch provisions changed a lot of things. Take advantage on saving after 70.5. Take advantage of Roth conversions. Start looking at these trusts you're using. Use these charitable planning tools, in your planning techniques. One thing I just wanted to pitch here from us, I know we're running out of time, is we're doing these live Secure Act CE events, both American College CE for all the CLUs and FSCPs and all those individuals out there, and CFP CE, kind of across the country, Houston, Dallas, Chicago, Philadelphia, Denver, and we've got some dates up there on the screen for those. And if you are a NAIFA member, feel free to reach out. We'll try to get these out through the local chapters with a code to get you in there. And then also, Judi, I want to make sure that we plug the NAIFA Congressional Conference here. So real quick, for everyone listening, can you tell us a little bit about that? You've got great turnout most years there and a big impact.
Yeah, so it's a pretty impressive group that hits the hill, Jamie, this year it will be Monday, May 20th. We'll be meeting with members of Congress. We cover almost 100% of Congress. This year we'll be talking about what you do in your communities, how you work with people, how life insurance works, how annuities work. What we're finding is a lot of members, there are a lot of relatively new members, and their staffs are not actually aware. And if we're going to have new retirement packages and we're going to have tax law changes, it's very helpful for them to have an understanding of how our industry works and the good that we do and the need to preserve the current tax treatment of our products and the planning that we do. It also is a lot of fun. It is not labor intensive on the meeting side. It's a half a day on one day. We get you ready to go to the Hill. The meetings are scheduled for you. You show up, you talk, you take pictures, you're working with your colleagues. We almost always have good weather. It is absolutely a beautiful time of year to come to Washington, D.C. Come and bring your families and do the other things. I would if I were coming from in the middle of the country, I think. But it's a real opportunity to get to know your members of Congress face to face, and that is a key factor in being able to build credibility and then call one day when it's an emergency and say, this is a good thing because, or this is a bad thing because, and have your opinion influential. So come, it's a lot of fun. We would love to see you.
Great. So again, I know we ran a little bit over, everyone. Judi, thank you so much and for all the great work you do there at NAIFA and helping move all this legislation through. And thanks for being on here today.
And thank you for including NAIFA. This has been a really great, comprehensive, easy to understand, wonderful presentation.
Great. And thank you, every NAIFA member, Carson kind of group person that's out there in the world paying attention to us. And again, if you have any questions, feel free to reach out to me or, as you said, put a question in. We will answer those. My email is jhopkins@carsongroup.com if you have any specific questions. But otherwise, thank you so much for being on here. Sorry we couldn't get the questions, but we will get those out. Have a great day, everyone, and best of luck helping your clients here in the future.
Great day.